Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, the last time I did this show was 2 weeks ago, and I said I was going to have a break until after the US election and we knew the result of that election. Well, as things stand right now, we don't know the definitive outcome of that election. It's now in the balance. It does look like Joe Biden is the most likely candidate to win, but it's not 100% certain just yet. But I thought it was worth doing a show just to draw your attention to the sort of movements we've had in markets, but more importantly, as long-term investors, to learn the lessons of the last couple of weeks, because there have been some valuable lessons, and they are about chasing narratives and actually doing nothing. There were two things. Go back and watch the last show that I did, and I mentioned that a lot throughout that show about the dangers of chasing narratives within markets and actually the benefits sometimes of doing absolutely nothing in the face of uncertainty. So if we go back to what's been happening in the last couple of weeks. Now, 2 weeks ago, we had the market picking up. Tech stocks were starting to show a little bit of early signs of weakness. We'd had the market at the beginning of September rally, pull back, particularly the technology stocks. We had bond markets fluctuate over the last couple of months. Really, despite these rallies and pullbacks in various asset classes, they have been fairly range bound. Now, some of those ranges have been fairly broad, but heading into last week, what happened is we had the tech earnings. If you remember, I mentioned last time the tech earnings for some of those big giants in America. So the likes of Facebook, we even had Amazon, we had Apple, and those earnings were actually, on the whole, very good. But markets still pulled back, and ahead of the US election, we actually saw the worst week in equity markets in America ever before a US election. Now, there were a number of reasons why we had that, and that was replicated around the world. I mean, we saw the German DAX fall below its 200-day moving average. We saw the FTSE 100 collapse down to 5,770. At the moment, it's managed to bounce back up towards 5,900, but I'll come on to that rebound in a second. But the reason for that was, again, the nervousness around COVID and the likelihood of lockdowns. Now, having made this video, we are entering a lockdown in the UK. There are lockdowns happening around the rest of Europe. Will we see one in the US? Only time will tell. There were also concerns about the likelihood of stimulus from the US government ahead of the election. Well, that didn't end up happening, and so everybody was pricing in the likelihood of stimulus after the election, assuming Biden would win, because the polls were predicting a blue wave. That means that Joe Biden was likely to win, or was predicted to win, the presidential candidacy, but also he was likely to win Congress. So we're going to get the Democrats win Congress. So this blue wave, basically, that the Democrats were going to have control of US politics, would mean that this stimulus or potential stimulus in America from the American government was going to be more likely. And actually, markets had nailed it on as pretty much a certainty. They've been pricing markets and assets, assuming that there would be this wave of stimulus from the US government. Well, of course, it didn't appear before the US election, and so that ended up having a bit of a downward pressure. It was a headwind on markets. And of course, there was some uncertainty about the outcome of the US election. As things got a little bit closer, people became a little bit uncertain about whether we would see this blue wave and started to take a bit of risk off the table. And as I said, what happened, we had one of the worst weeks in equity markets before US election. The S&P 500, for example, was down 6%. Most developed world equity markets, whether it be in the UK or Europe, were down 3 to 4%. Asia, on the other hand, was fell far less. It actually only fell about 1%. So, as I've mentioned in previous episodes of this, Asian equities still are proving a good diversifier within the equity portion of your portfolio at the moment. Chinese equities in particular. And I mean, if you look at some of the Chinese tech stocks, they've been doing particularly well, and it seems to be they're taking no notice of what's going on in America and American politics. Of course, we've still got the Brexit scenario. They were trying to get an agreement between the UK and the European Union on that withdrawal agreement. That's still not happened, and that's now being postponed until some point in November. So hopefully there'll be some outcome to that, something positive. But it all led to a lot of uncertainty last week. We saw the VIX, the Fear Index, the VIX, at its highest level since March. And it meant that a lot of people were uncertain going into this US election. Now, you would have seen a lot of investment banks and headlines predicting this blue wave. And the Biden win hasn't materialised quite how they thought it would. And of course, it meant that a lot of people were positioned for a lot of downward pressure on markets, so taking risk off the table. But what we've seen is as soon as the idea or the likelihood of this blue wave happening, then asset prices were quickly re-rated, they would change. So we saw equity markets explode higher. I'm talking particularly about US technology stocks. Now go back a week, people were pretty much saying that you were crazy to be owning US tech stocks. They were extremely overvalued. There was a high risk going into this election. You were looking at treasury yields. There were a lot of investment banks saying they were going to explode higher. We're going to get collapse in bond markets. And so everybody was starting to follow a particular narrative. Of course, the blue wave didn't happen. So markets have suddenly reacted. And the reason why tech stocks have suddenly exploded higher, because they have been pretty much a defensive play a lot this year. Combine that with the lockdowns we're seeing around the world, and also they did have some very good earnings. People are seeing that as a safety play. They're rushing towards growth stocks. And because the blue wave is now unlikely, what it means is there's less likelihood of a big US governmental stimulus package after the election. So we're sitting there thinking that, well, possibly we could have a US economy that's only going to be able to rely on the Federal Reserve coming to the rescue. So what's happened, investment markets have rushed to reprice that scenario. And of course, if in that scenario, if we're going to get a scenario where perhaps the US economy isn't going to be supported as much by the government, then value stocks, cyclical stocks, suddenly become things you don't want to own. And so they've been sold down. They performed worse in the aftermath of the US election. I mean, it's only a couple of days since the election votes were actually placed, but we've seen a movement back into growth stocks. And for example, we saw US technology stocks leap 5 to 7% in a single day. The Nasdaq 100, for example, the day after the election, was actually up about 4%. And as I make this video now, the futures point towards another 2% higher. And that's in stark contrast with a lot of other markets that were initially down after the election. But when they did recover, they recovered nowhere near to the levels that we've seen in technology stocks. As I say, bond markets have repriced. We saw the 10-year UK gilt yield collapse. Partly that was because obviously there was concerns about the lockdown, but it was a safety trade. People started to buy assets that could do well in an environment where the economy globally in the US, the UK could be facing some headwinds. So that means bonds, so treasuries have done well, UK gilts have done well. So in simple terms, if you'd held UK gilts and technology stocks were the things that last week were the very things that people were telling you that were going to collapse, you would actually be sitting on some pretty handsome profits in the last couple of days. And these are the sort of assets that over the last 6 months have been doing particularly well. And a lot of these episodes I've been talking about waiting to see what happens with these trends. These trends have still been respected, even though we've seen some pullbacks in these markets. So we saw technology stocks pull back, but again, we saw some strength and it rebounded. The uptrend still intact. The same can be said for the downtrend in yields that we've seen in most developed world bond markets. They've been respected. We've seen the yields start to pull back and start to fall, which means the price of those bonds goes up. So whenever you hear these narratives keep changing and people are chasing them, they're being badly burnt. And the reason markets are spiking high after this election at the moment, don't forget this could all change. I mean, in a couple of days' time, we could have everything start to reverse for whatever reason. But the reason they're spiking high is because everybody's been wrong-footed by betting with the consensus and trying to front-run that trend. And 80/20 investor members will know that I did a piece recently which was all about, it's not about being first, it's about being right. And by that I meant that you don't have to be the first person to jump on a trend, you just need to be on a trend that is right, that is actually going to be sustainable. And we're seeing lots of people flip-flop and chase trends which are now unraveling and going back and forth. And as a result, they're being badly burnt. And it's a trend we've seen all year long. So you may remember after the coronavirus outbreak, we saw certain trends strengthen. We saw technology stocks do badly initially, but then actually they then pick back up again. So it's something we've seen repeated time and time again. It's a lesson to be learned as a long-term investor. Don't make knee-jerk reactions. And one of the things that the market is now starting to price in is a potential for the Federal Reserve to come to the rescue once again, as it did after the coronavirus outbreak in the spring. In the UK, the Bank of England has already increased its own quantitative easing program. So it's very likely we're going to see something else in America, and perhaps elsewhere. Maybe the European Central Bank might step in and help markets. So the message of this show, while markets have now recovered to a level that we saw perhaps 2 or 3 weeks ago before the weakness ahead of the US election, we still don't know what the outcome is. Things are still very much up in the air. But what you've learned from the last couple of weeks is not to believe the headlines, not to believe the narrative, not to believe the people who think they can predict the outcome of any future event, regardless of whether it's an election or not, and then place their portfolio accordingly. You're better off following the trend and waiting to see what happens. And as long-term investors, you don't want to get caught up in these short-term nuances of investment markets. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien@moneytothemasses.com is the email address. You can contact me Twitter. Money to the Masses is the Twitter handle with the number 2. Facebook, Instagram, and of course you can subscribe to our YouTube channel. And hopefully by next week we'll have a little bit more clarity on what's going on, not only in the US election, but also in investment markets.